Well, we think interest rates, at least short-term interest rates, are going to stay very low for several years. The Federal Reserve has basically given us guidance that they expect no change in the Fed funds rate, which currently sits at 0 to 0.25%. They see no change in that rate until about 2023. The Bank of Canada seems to be on the same page as the Federal Reserve. They haven't given guidance for as long a period, but the central bank governor here has said he's going to keep interest rates low as well for an extended period. Now, longer-term bond yields, they could rise a little bit over the next 12 months because we do see a better economic recovery than the consensus expects. So a little better recovery here in Canada on the growth side means you could see a little bit of a drift higher in long-term yields. One thing we're also thinking is going to cap the potential for long-term yields to rise is yield curve control, which may be coming as soon as September in the U.S., where the central bank targets longer-term bond yields and won't allow them to rise above certain levels. So yield curve control is something the Federal Reserve did from 1942 to 1951. And they basically just decree that longer-term bond yields, let's say the 10-year government bond yield, like that time they said would not be allowed to rise above 2%. And that they would buy bonds if need be to push the yield back down below that level if they exceeded 2. Now, they didn't have to spend any money to do it. Basically, just decreeing it was enough for the market to behave and keep those bond yields below that target level. So that could be coming. We could get an announcement on that as soon as September this year. Well, bonds always have a place in investors' portfolios, but there's different types of bonds. Government bonds, which we think you always should have some government bonds, or they do tend to perform well when the economy runs into trouble, like we saw in the second quarter this year. Interest rates plunge as investors rush for the safety of high-quality assets like government bonds. Corporate bonds are something that tends to perform better when the economy is recovering, which we think is going to be the story for the next 12-month period. So we think corporate bonds can outperform government bonds to the tune of around 3.5% in the next 12 months. And that's the investment grade side, high-quality investment grade corporate bonds. We think high yield is going to do even better than that, perhaps outperform government bonds by as much as 7%. That's all predicated, of course, on the economy having a good recovery over the next 12-month period, a little above what the consensus is expecting at the present time. So bonds always have a place, but you should be looking at the mix of bonds you have in your portfolio. You can look at other things as well, like international bonds. That could provide you with some currency exposure, and that could help to augment returns and even lower your overall volatility. We still think that corporate bonds are the better place to be over the next 12-month period. And yes, we've had some strong performance in those in the last couple of months, but if you look back at where we were at the end of 2019, the extra yield you get on corporate bonds above government bonds was about 130 basis points or 1.3%. That went to as high as 3.5% at the peak of the panic, and is down to about 185 basis points. So there's still room for further compression or for that gap to narrow in the next 12 months, and that would allow corporate bonds to outperform government bonds. The high yield sector, we think, has even better prospects. The extra yield that those offered was only about 350 or 3.5% at the end of 2019. That went out to over 1,000 basis points or 10 percentage points at the peak of the panic, and is down to just above 500 basis points now. So there's still room for those spreads to compress further and allow high yield bonds to outperform both investment grade and government bonds in the next 12 months. Defaults are always something to be cautious of when you have an episode like we have now, but the bond market tends to be a shoot first and ask questions later, and we've already seen a strong response from the bond market given the pandemic. The second quarter of 2020 had, I think it was the second highest default rate in history, around a little over 6%. We're running over 6% year to date on default rates on high yield bonds. And a lot of that really is the energy sector, which really suffered, and some of the retailers as well. You've seen some grocery stores and other retails shutting down in the second quarter. It's a lagging indicator as well. The bond market tends to get well ahead of these issues. They've already punished a lot of those sectors that have will suffer and have suffered and will suffer further going forward. So we're not that worried about the default rate rising. We think it will rise further. We try to mitigate those risks by having an in-house credit analyst team that does bottom-up analysis of companies to try and ensure we stay away from those companies that have trouble. We minimize our exposure to individual companies. In those portfolios, we tend to have less than a 0.2% weight on our average high-yield company as exposure. So those companies, if any one of those companies has a lot of trouble, and the bonds get hurt really hard, the prices could go down 30, 50, 70%. It's not going to be anything that really hurts the entire portfolio because our exposures are so well managed. One thing we're really focusing on as well is what's going on with inflation. Now, we've heard inflation's coming back. I mean, I've been doing this 30 years, and I've heard for 25 years of that inflation's coming back. It just doesn't seem to come back. But with the amount of money printing that's going on, all this quantitative easing and buying of bonds and other stimulus measures, there's a lot of liquidity sloshing around the system. And you are running the risk that, given the fact that transfer payments in the U.S. and the Federal Reserve, et cetera, they've replaced about 1.3 trillion of lost income with about 3.1 trillion of transfer payments, the Paycheck Protection Program and other measures. So there is the potential that inflation could finally surface at some point, perhaps not in the next year. We don't really see that as a risk, but 2, 3, 4 years down the line. You don't tend to be overly worried about inflation surfacing when you have a large output gap, the difference between actual growth and potential growth. And that gap has opened up quite large since the pandemic hit. That tells us inflation is not anything to worry about in the near term over the next 12 months, but our eye is on that for indicators longer term. And the longer term indicators we're looking at the present time aren't flashing any warning signs at the moment, but it's something really that bond investors will have to pay more attention to as we go through the next 12-month period.